Wall Street is pouring billions into technology companies. Stock indices are testing new highs, and trading floors look like an aggressive, unstoppable bull run. But step off the trading floor and the picture changes. Household credit card debt has eclipsed $1 trillion, and the cost of keeping the lights on is draining bank accounts faster than wages can refill them. The United States is broadcasting two completely opposing economic signals. By all standard metrics, we are living through a massive corporate boom and a painful, localized recession at the exact same time. The force propping up the boom is artificial intelligence. Massive amounts of capital have bypassed traditional industries, flooding directly into AI development. A country cannot run two divergent economies forever. Either this multi-trillion-dollar bet on technology pays off, or the average consumer runs out of cash. The friction slowing everyday life comes straight from the top. The Federal Reserve clamped down on the money supply to keep inflation from running hot. When the Fed keeps its target rate high, that cost trickles down through the entire system. A standard 30-year mortgage becomes expensive. Business loans dry up. Credit card rates exceed 20%. This has created a bizarre bottleneck in the labor market. On paper, there are millions of job openings, but in reality, the actual hiring process has practically frozen. Companies want to grow, and they want the staff to expand their operations. But in a high-rate environment, adding permanent payroll costs is a massive liability, so they leave the job postings up and wait. All of this gridlock falls directly onto the shoulders of everyday shoppers. Right now, everyday spending is the single engine keeping the broader U.S. economy from shrinking into a contraction. Mathematically, that bottom-up engine cannot run much longer. Organic growth driven by consumer purchasing power is completely stalled under the weight of these borrowing costs. Meanwhile, the technology sector is entirely ignoring that consumer squeeze. Investors are aggressively funding the infrastructure required for AI, the massive data centers and microchips. They justify this massive expense with long-term corporate productivity. On this scale, heavy borrowing costs drag down corporate balance sheets. But investors bet that adding AI efficiency fixes the equation. If software doubles output without new hires, the profit margin overwhelms high interest rates. The problem is proving it in the real world. Outside of Silicon Valley, traditional sectors like healthcare and heavy manufacturing are still struggling to integrate these tools. The actual efficiency gains remain largely hypothetical. If that productivity doesn't materialize soon, Wall Street has priced a savior into the stock market that simply doesn't exist. That miscalculation introduces a systemic risk that could tear through every major index. The grace period for that hype is ending over the next few months. Tech giants have to open their books and prove to Wall Street that their heavy investments in AI infrastructure are actually generating cash flow. While traders scrutinize those balance sheets, the Federal Reserve will be quietly parsing employment and inflation data to determine if the American middle class is finally cracking under the pressure. There are two distinct paths forward. We can map the optimistic soft landing scenario on this dual line graph. If AI delivers real-world productivity, corporate output rises steadily. Companies grow their way out of the high-rate trap, which gives the Fed enough breathing room to stabilize the economy and allow consumer costs to gently slope into a safe zone. But the alternative is immediate. If earnings reveal that AI is currently just an expensive cash burn, that corporate output line flatlines and drops. Without a technological cheat code, panicking companies realize they are stuck with high debt, forcing the red consumer burden line to spike violently into the danger zone. To survive a miscalculation of that scale, corporations will turn to the fastest cost-cutting measure available, mass layoffs. And those job cuts will directly hit a consumer base that has zero financial cushion left to absorb the blow. The next move for the American economy is no longer a simple waiting game for interest rate cuts. Everything relies on a $1 trillion technology bet executing flawlessly before the financial strain on the middle class breaks the system.